Okay, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of these podcasts. Nothing that we're going to go over today or any of our other materials should be taken as investing advice. Make sure to do your own research before making any investment decision. With that being said, the topic of today's video is going to be plug power. Now, we made an episode on plug power a few months back where we talked about kind of how the company goes to market, what its business model is, and why we are a little bit more on the bearish side in terms of their medium to long-term prospects. If you haven't watched that episode, I highly encourage you to go back and watch that before continuing with this episode. We'll link the that video in the description below. So with that being said, today we're just going to go over some updates on plug power that's happened recently, and that has led to some crazy stock price action. So with that being said, I'll hand it over to you, James, to talk about what exactly has been going on.
Yeah, so if you look at, we'll start with Plug Power's stock price performance since the beginning of the year, so in January. In the first half of January, the stock, absolutely plunged, decreased by 50% year to date by the middle of the month. But then after that, the stock doubled and basically recovered all those losses. So now, for the month of January, it basically ended flat, but obviously with huge volatility in between. So what was the driver of all this volatility? Well, on January 17th, Plug Power announced an authorization that will allow them to sell up to $1 billion worth of stock over the next 18 months. So this was viewed as very bearish by the market because it shows that Plug Power is still burning cash and they need to do this massive dilutive financing just to stay afloat. But then on January 23rd, Plug Power hosted an earnings call with investors where they talked about where the CEO, Andrew Marsh, as well as other Plug Power executives, gave some very bullish commentary about 2024. And, that along with some other developments caused investors to get bullish on the stock again. And that's why, we saw this massive rally over the past couple of weeks. So what exactly did Plug Power say at this conference call? So there's a few main points. The first point is Plug Power has been trying to get a $1.6 billion loan from the Department of Energy. This is part of the Inflation Reduction Act and the hydrogen subsidies. And Andrew Marsh, the CEO, said that they are in the late stages of negotiations with the DoE, and they expect to get this loan by the end of this year. Secondly, he says that Plug Power is going to be increasing the prices that it charges to its customers, both for the hydrogen fuel itself as well as the associated hydrogen equipment that they sell. And so those price increases, he says, will help to increase their margins. And when I say increase their margins, their gross margins are currently negative. So by increasing the margins, that just means that they're going to be less negative. Additionally, they are doing a hiring freeze. So they're not doing layoffs, but they're not hiring new employees. So their headcount should decrease over time with attrition. That'll help them conserve cash. Their hydrogen production facility in Georgia was just completed. It's begun production, and just very recently they have made their first deliveries to customers with the green hydrogen they produce themselves at the Georgia facility. And finally, he said that the company's rate of cash burn for 2024 will be 70% less than 2023. So they're still going to be burning cash, but they say that they're going to burn far less cash than they did last year. So we'll go through each of these points one by one and kind of dig a little deeper. So on the issue of the DOE loan, the exact language that the Plug Power executives used when talking about it is worth analyzing. So they said that we were notified yesterday that the application has been submitted to the credit review board for their final consideration and issuance of a conditional commitment. This funding, when received, will support development and construction of up to 6 hydrogen production facilities. So it's important to look at exactly where they are in this process. They said that they have submitted the application for final consideration. So the DOE is still doing the final consideration of Plug Power's loan application. They have not yet approved it. But then, they're talking about, then in the next sentence, they're talking about it as if it's definitely going to happen. He said, this funding, when received. They didn't say if received, they say when received. Well, I think that, their language is a little aggressive there, because how can you say when received as if this is a sure thing when the DOE hasn't even finished their final consideration? So I think maybe they're being too optimistic. But let's just say even if Plug Power does get this loan, they've talked about that it would be kind of a 5 to 7 year duration, and the interest rate would be somewhere around 6.5%. Now, given Plug Power's disastrous financial performance, if they were to go into the private markets and try to raise debt, I'm sure the interest rate would be way higher than 6.5%, if anyone would even be able to lend to them at all. So this 6.5% that they would expect from the DOE is certainly a subsidized rate. But given that Plug Power is losing money and has negative gross margins, how are they going to even be able to pay this loan back and pay the 6.5% interest on top of that? Okay, so just because they get this loan, they have to pay back that loan eventually. So it doesn't solve the core problem that their business is losing money. The next thing is that in the third quarter of 2023, which is the latest quarter for which we have a 10Q, the auditor gave them a going concern notice. And that basically means that based on the auditor is saying that based on Plug Power's current financial position and the current trajectory, they are not confident that Plug Power will be able to survive for another 12 months. It basically is the auditor saying this company is on the brink of bankruptcy. So for the government to give a $1.6 billion loan to a company that has a going concern notice and is on the brink of bankruptcy, I think would be absolutely outrageous, and would probably be like a political disaster for the Biden administration if they give a loan to Plug Power and then Plug Power goes bankrupt and the taxpayers lose a lot of money. So that's why I'm a little bit skeptical that this loan is even going to happen. But we'll see. And I think it's really more important to look at the fundamentals of the business, because just getting a loan from the government that you have to pay back with interest is not going to save the business if the business fundamentally is not profitable. It'll just be kicking the can down the road. And so the next issue to think about, also related to the Inflation Reduction Act, is there are hydrogen subsidies where hydrogen producing companies can get up to $3 per kilogram of a refundable tax credit if they're producing green hydrogen and they meet various requirements. So this has been viewed as extremely bullish for the hydrogen industry as a whole, and for Plug Power in particularly. And if you look over the past year or two, or pretty much since the IRA was enacted, Plug Power has always been talking about, how great this is going to be for them. But in December of 2023, the Department of Treasury finally released the rules of exactly what requirements companies have to make in order to qualify for these subsidies. And these requirements were much stricter than a lot of people expected. So this is a quote from the recent press conference from Plug Power. They said that some of the IRA guidance on various provisions this year were favorable to Plug, but recent guidance on the production tax credit and manufacturing credit elements were not as favorable as expected. Okay, so Plug Power themselves are telling us the recent guidance was not as favorable as expected. So here on the bottom left, I have the three main requirements in order to be eligible for these green hydrogen subsidies. So green hydrogen subsidy for hydrogen to be green, it has to use you have to use renewable electricity to create the hydrogen. And if you look at the third requirement, the green energy that you use has to be incremental. So it has to be from new clean power plants. And the rationale behind that is, let's say, if you use existing renewable energy power generation that already exists, and you create a hydrogen production facility and use electricity from an existing green power plant, well, that green electricity that you're taking is just displacing somebody else who is already using that electricity. So there's going to be kind of a net increase of demand onto the power grid, which is going to have to be satisfied by new electricity production. And that new electricity production may or may not be green. So if you make a green hydrogen production facility and tie it to existing green electricity, it may or may not even have a net benefit for carbon emissions. So that's why one of the requirements is that it has to be incremental green energy, right? So it has to be, you're building a new hydrogen production facility, and then you're also building a green energy facility at the same time to supply your electricity. It has to be incremental. Now, this could be bad for Plug Power because they're working on a few different hydrogen production facilities. They have one in Georgia that just went online. They're also working on one in New York, Texas, and Tennessee, which are supposed to be coming online later this year. For most of them, they haven't given a lot of disclosure of exactly what the electricity source is. But one of the facilities where we do know the electricity source is their production facility in New York, which it's not completed yet, but it's expected to be completed this year. And that facility gets its electricity from the Niagara hydroelectric dam in New York State, which was commissioned all the way back in 1961. So that's obviously not an incremental green energy source because it's been there since 1961. So I would think that this New York facility is not going to qualify for the IRA tax credits. So that's a big problem for Plug Power. Now, I don't know exactly if any of their other facilities are going to qualify because they've only given very limited, if any, disclosure about their electricity sources. But the fact that they're coming out and telling us that these requirements are not as favorable as expected makes me believe that a lot of their production is not going to be eligible for the subsidies. And so now kind of to the bread and butter of probably the most important thing that Plug Power talked about in this recent earnings call. So as we talked about in our previous video, Plug Power has negative gross margins. They sell both the hydrogen fuel itself and the equipment, the hydrogen equipment that they sell. They sell it to their customers at a lower cost than their own cost to produce. So they have negative gross margins. And that's obviously been a disaster for Plug Power and why they've been always losing so much money. So now they say we're finally going to start increasing our prices, and that will help us with our gross margins. Well, that sounds great, but if it was really possible to raise prices, why didn't they raise prices a long time ago, right? Why did they burn billions of dollars of shareholder money over the past few years, basically subsidizing their customers instead of raising prices earlier? Well, the only reason Plug Power's customers agreed to start using hydrogen is because Plug Power was willing to subsidize it. Because hydrogen, in the vast majority, almost all use cases, is not economically viable. So either electric options or fossil fuel options are almost always cheaper than hydrogen. The only reason any of Plug Power's customers were willing to use hydrogen for their forklifts and also for some other applications is because Plug Power was willing to give it to them at a subsidized price. Now, if Plug Power stops the subsidization and starts charging, at least their own cost or even trying to make a profit, well, then these customers, more likely than not, are just going to say it's too expensive, and we'll just go back. Instead of using a hydrogen forklift, I'll just have to go back to using a propane forklift because that's way cheaper. So that's really the fundamental problem, is that the hydrogen is not economically viable. And that's why they had to do the subsidization in the first place. And responding to some, questions, some of the analysts who were on this recent call with Plug Power were asking the CEO, what are your conversations with customers like? Are the customers willing to accept these price increases? And here's what the CEO said in response. He said, "Look, it's never easy to raise prices. Wouldn't tell you these are great conversations. But with some of our customers, we've been discussing this for about 5 or 6 weeks. So I think everyone knows for this industry to be viable, for Plug to be able to support their long-term needs, that is a necessity." So obviously the customers are not happy with having to pay higher prices with the price increases, but Plug Power is telling them, if we don't raise your prices, we're going to go bankrupt. And then, the implication is that the customers would just say, okay, well, we don't want you to go bankrupt, so we'll accept these price increases. But there's another option, which Plug Power CEO is not talking about here, which is what I just talked about. Well, they can stop using hydrogen altogether and go back to traditional methods like propane or compressed natural gas for their forklifts. So I think that's a really concerning sign. If they really do a price increase that's big enough for them to be gross margin positive, I think there's a high risk that their revenue will collapse. And now, kind of what I think is the most outrageous part of, at least in my opinion, of this earnings call is they continued, with this fantasy that when they open up their own green hydrogen facilities, that this is somehow going to be way cheaper than the gray hydrogen that they used to buy from third parties, right? So in the past, they would buy gray hydrogen created from natural gas from third-party suppliers and then resell that hydrogen to their customers at a loss. Now they're building their own green hydrogen facilities, and that's what they're going to use to supply to their customers. And here, they're saying that their new green hydrogen at their own facilities is expected to be 1/3 of the market cost. And that's even before the subsidies, which, as I said earlier, they may or may not even get these subsidies. But they're saying that even before subsidies, their green hydrogen is going to be 1/3 the cost of the gray hydrogen that they used to buy. Now, if you watched our previous video, we go into very deep detail about why we think this claim is complete BS. And the most important thing to understand is that this is also in our video previously. Bloomberg released an article last year, and they did a comprehensive study of hydrogen prices all around the world. They looked at markets all around the world, comparing the prices of gray hydrogen versus green hydrogen. In every single market that they looked at, the gray hydrogen is cheaper than the green hydrogen. And now Plug Power is saying that their green hydrogen is going to be 1/3 of the cost that's compared to the gray hydrogen that they used to buy. Now they have given no realistic and comprehensible explanation as to why that is. They've given basically a bunch of BS reasons that are inconsistent and contradictory to each other. But I still do not believe for 1 second that their green hydrogen is going to be cheaper than the gray hydrogen. And another thing that really caused Plug Power's stock to skyrocket, this was a few days after the January 23rd conference call, is there's a investment bank called Roth Capital which covers Plug Power stock. And they just increased their price target to $9. And this, created a lot of bullish sentiment. And they said that they visited the Georgia green hydrogen plant. They physically went there and visited it, and they saw that it was ramping up production smoothly, and that the various technical issues that they had in the past had been addressed. And this has addressed Roth Capital's concerns about backlog and margin visibility. So they basically went to this to the Georgia facility at the invitation of Plug Power's management, saw that the facility indeed exists and is indeed working. And then they said, oh, this is great. So now we have margin visibility, that the margin is going to improve because Plug Power told us that this green hydrogen is going to be at 1/3 of the cost. But they're just taking the management at their word. So yeah, I don't doubt that the Georgia facility is real and it is indeed producing hydrogen. But there's still no evidence that they can produce it for 1/3 of the cost like they're claiming. And until they actually give us some real evidence of this, it's not something that I'm going to believe. And the next thing is the cash burn, right? They said that they're going to reduce their cash burn by over 70% compared to 2023. Now, at first, this sounds really good, right? They're going to massively reduce their cash burn because they're increasing prices and reducing costs, right? It sounds very good, but if we actually dig deeply into it, it's really not that good as it sounds. So how are they going to achieve this? How are they going to achieve this reduction in cash burn? Firstly, they say that they're going to have much lower capital expenditures in 2024, only about $200 million. They will have no investment in working capital, and they say that they'll have improved margins. And then they also said that because they're not going to invest in working capital, they're basically going to allow their inventory to run down. Some of the projects with negative gross margins will actually generate cash in 2024. So how is that possible if you have a negative gross margin? Well, if you've built up a ton of inventory, and then you sell that inventory at a loss. So you build up a bunch of inventory in 2023, you sell that inventory at a loss in 2024, and you do not replenish that inventory, you technically have a positive cash flow in 2024, even though you made an accounting loss because you sold it for less than it cost you to produce. So that's kind of going to be the drivers of this reduction in cash burn is really CapEx and working capital. So to quantify this, in 2023, they burned about $1.7 billion in negative free cash flow. So they say they're going to reduce that by 70%. So that means in 2024, they're going to burn about $500 million. So there's $1.2 billion of savings. How are they going to achieve that? Well, we don't have the numbers for Q4, but they probably spent about $650 million of capital expenditures in 2024. Or sorry, in 2023. So $650 million of CapEx in 2023. Now they say they're only going to spend $200 million of CapEx in 2024. So there's a $450 million of cash savings from less CapEx. Secondly, their inventory increased by $400 million in 2023. And now they're saying that their negative gross margin products will generate cash, which means that their inventory is going to reduce, right? They build up inventory in 2023, decrease that inventory, sell off that inventory without replacing it in 2024. So there's going to be at least a $400 million benefit from inventory compared to last year. So if you add those together, that's $850 million of improvement just from CapEx and inventory. So excluding that, there's only $350 million of benefit, or there's only $350 million of improvement from the core operations, right? From increased margins. So they talk about this big, 70% number as it's so great. We're getting so much better. We're getting close to profitability. But that's purely due to capex and inventory. And the thing is with inventory, yeah, you can generate positive cash flow by selling off your inventory, but you can only do that once. Eventually, you're going to have to replenish that inventory and have a negative cash flow. So I view this, this 70% number as basically BS, even if it is true, it's not nearly as meaningful as they're trying to make it out to be. And their operating loss in the trailing 12 months from Q3 was about $900 million, right? So they say that they're going to have, $1.2 billion of cash savings. But if we exclude the capex and inventory, their operating improvement is only $350 million. So based on that, we'd still expect them to have an operating loss of $550 million in 2024, which is still an extremely massive loss. And I think it's important, all of these bullish promises that Plug Power's management is making. It's important to put it in context versus their prior guidance and how disastrously they've missed their previous targets. So let's go all the way back to March of 2020. This is a direct quote from one of their earnings calls at that time. They said, "So you're going to continue to see real strong margin progression through this year." That was in 2020. What happened in 2020? So they had a gross profit of negative $400 million, and they had negative revenue. That was from an attack. That the negative revenue was the result of an accounting technicality related to some of the warrants they gave to their two biggest customers, Amazon and Walmart. But either way, 2020 was a disastrous year. Now let's go on to March of 2021. They were also giving a conference call, and they said, "Our goals for 2021 are clear. Gross billings of $470 million, annual gross margins in the high teens, achieving 20% by the fourth quarter." So they say they want to get up to 20% gross margins. Well, what was their actual gross margin in that year? It was about negative 10%. Then go to March of 2022. They say their production will start. They're talking about their own green hydrogen production will start to ramp at the end of 2022 and have a significant impact on 2023. That will take the business that is negative margins today, and you can expect that to be a 30% margin business, right? So they say that their fuel business, which is negative margin today, we're going to get all of our green hydrogen facilities up and running, and then by 2023, you're going to see real margin improvement. Well, what happened in 2023? Their gross margins got way worse to like negative 35%, disastrous. And then, okay, they always have an excuse. Oh, we had some delays here. There was some unexpected, bottlenecks in some of the hydrogen markets, et cetera, et cetera. They always come up with excuses. But when it's year after year after year, they're talking about how their margins are going to get better, but every year they get worse. And then now in 2024, they're basically coming up, with the same trick again, saying, just give us another year. Everything's going to be really good this time. But at the end of the day, the fundamental problem is that green hydrogen is not economically viable. And, no matter what kind of story they try to spin or what kind of BS they try to tell us, just look at their track record. And, are these really people you're going to trust with their insanely bullish projections? And then kind of the most, clownish thing to come out of this story is that this was from a couple days ago. Andrew Marsh, the CEO of Plug Power, gave an interview to Barron's, and he was talking about he was asked about Plug Power has a very high short interest. There's a lot of short sellers betting against the stock, and one of the biggest kind of bear cases around Plug Power is the fact that they just authorized this $1 billion stock offering that they're going to do. And given that Plug Power's market cap is currently less than $3 billion, this $1 billion stock offering is going to be massively dilutive. And then, so here's Andrew Marsh responding to those criticisms. He says, "Everybody's thinking I'm going to issue common stock, and that's probably not necessarily what we're going to do. He then says that the short sellers betting against the stock could be in for a surprise. So what is he talking about? It's honestly not really clear. So Plug Power filed an authorization so that they can issue $1 billion of stock, of new common stock. And we also know that Plug Power, they've just told us that as of the end of 2023, they only had $140 million of cash on hand. And by their own guidance, they're going to burn $500 million in 2024, right? So they're going to burn $500 million in 2024. They only have $140 million now. And even if they get the DOE loan, that's not going to come until the second half of 2024. So that $140 million that they have today, they're going to burn it in the first half of this year. So they need more cash. And the only way they're going to get that cash realistically is to issue common stock. So what is this guy talking about? Saying that he's probably not necessarily going to issue common stock when he needs the money, and they even had an authorization to issue common stock. It's completely nonsensical. And you have to keep in mind that Plug Power, they have this authorization. They're probably going to issue common stock. And obviously, they want the stock price to be as high as possible when they start selling the stock. And then you have the CEO making these like super weird statements saying that he has a surprise for short sellers. And then, all of like a bunch of sort of like the Wall Street bets kind of traders, they see this like, oh, it's going to be the next short squeeze. All of them pile into the stock and the stock price increases. I mean, this is like almost like market manipulation where he's making these weird statements to try to pump up the stock because they're about to sell a bunch of stock. So this is just super weird. And at least for me, it does not inspire confidence in the company at all. And it does not inspire confidence in Andrew Marsh's leadership as the CEO. So all things considered, I still have almost zero confidence that this company will ever become a viable business. Nothing that they've said in this recent press conference gives me and changes my outlook in the slightest about the company's long-term prospects, because the fundamental, they can talk about price increases, they can talk about, the cash burn, they can talk about whatever they want, but the fundamental problem is that hydrogen, especially green hydrogen today, is not economically viable. And unless you believe their claims that they're going to somehow reduce the cost by 1/3, they're going to reduce the cost to 1/3 of what it used to be, which, as I've talked about previously, I do not believe at all. This is just never going to be a viable business. Even if they get the DOE loan, that'll just kick the can down the road for another year or so. But I do not see how this company can survive in the long term.
Yeah, I think taking a step back, to me, what this whole thing looks like is there's kind of two explanations that are possible for a company giving this type of commentary and doing everything that Plug Power has done recently. One is that you believe them and everything, all the positive things that they're saying is true. And the second explanation is this is just a company that's struggling, like countless other companies throughout the course of business history, and they're kind of at the end of the line in terms of cash. And so they're doing whatever they can to just preserve themselves, get through the next 12 months. And that means doing whatever you can to raise cash and increase the share price. And so it's just a matter of which of those two situations do you believe is the most likely scenario, given everything that they've done, their track record over the past few years of what they've promised versus what they've delivered, and the incentives for what could happen if they do get their share price up.
Yeah. I mean, either way, we'll definitely continue covering Plug Power on this channel going forward. So make sure to stay subscribed, and we'll keep you updated if there's any future developments. And before we sign out, I just want to take a minute to talk about our website, differentiatedanalytics.com. It has a broad range of resources for investors, including short selling research, merger arbitrage data, and a bunch of proprietary data we collect. And there are both free and paid tiers, making it accessible to everybody. And the paid option normally costs $20 a month, but we are currently still running our 75% off promotion. So you can get everything for $5 per month when you use the discount code WSM75 at checkout. And so all of that, the link to the website, as well as the information about the promo code, it's all going to be linked in the description below. So if this is something that might interest you, make sure to check it out in the description below.